Hey everyone. I want to record this video. It's kind of like a part three of how to trade Roblesh charts, but I want to touch a little bit more on setting entries, exits, and stops. Well, really, exits are both stops and take profits. So I'm going to use the example of this incoming April 6th as an example. And I want to break down a little bit as to some of my thinking and some ideas for your approach to the charts. Now, not everybody does it the same. Some people overlay the vector, which you see on here, multiple time frames, and they add it multiple times to get more reads of the same, of the vector tool. And then other people wait for breaks and retests of different areas like the dead zone, or like the wave 7 hourly vector. They'll look for that. Or some people literally just like set their limit and then set a wide stop. There's so many ways of approaching it. There is no one right way. I would say the best way is the one that you can manage well with good risk and not blow up and take advantage of profits with. Now, considering that we've been around the weekly vector, like this has definitely come with its own set of market conditions to be around the weekly vector. But in general, I want to touch on some principles that I use on a regular basis when trading my charts. So when I'm approaching my charts, I ask myself, what is my main bias for the day? And in that process, I decide either if I'm going to focus on one very key long idea, or one very key short idea, depending on my bias, of course. Long bias, long idea, short bias, short idea. Now, let's say the key area that I'm looking for longs from is from this support and resistance area. I ask myself, if price is going like this, I ask myself, do I want to take a position? For example, if I see price starting to show some very key reversion characteristics around here from real-time fractal software analysis and or some vector breakdown or some other confluence. This is my main idea. This is where my bias is coming from. I looked into fractal with all the analysis and all the experience that I have and I've developed that I share with guides in this community. And we have many, many materials on how to identify those high probability setups. If I ask myself, you know what, this looks really good to start making my way down here, I'm going to take a position here because I want to. I think it's pretty good to take this position here down to my main idea for the day. In that case, I will flip and go long. Now, that's one option. The other option is I see the market and it's kind of like vague what's happening. And I'm like, you know what? I'm not going to take a position into my long idea for the day. I'm just going to wait. So, depending on any variation or variables that might change as price starts doing stuff, then I will either start looking for setting limits at the top, in the middle, or at the bottom. There's no perfect way of doing it. The support resistance boxes I've mentioned many, many times are a combination of imprints, open states, average move bands, average mean waves, low percentage bands. So it's a combination of all those things. And I just write support resistance because I don't want to write entire paragraphs of stuff in just little text boxes. So I just write as support resistance and I ask myself, okay, based off of what's there and then what is still there as price is doing stuff, I'm going to set my limit, for example, in the middle. And this is how I do it. Now, this is not the only way of doing it, but I oftentimes am setting limits. and then I'll set my stop outside the box. I'll set my stop outside the box because great majority of the time my box is like the whole thing. The whole thing is a support or resistance. So I want to set my stop outside the box. Now, you might ask yourself, why is that so wide? Well, there's a lot of information that's consisting in there. And I'm not going to make my chart try to seem better just because my zone might be like really thin. If the fractal is showing me that the zone is 29.5 points wide, I'm going to make it 29.5 points wide. So, for risk management purposes, I'm just going to set my entry. Let's say that I like it. I like what's in the middle the most, based off of like real time after market's done some stuff for a little while. I'm going to set my limit in the middle and then just set my stop just comfortably away from the box. Now, these boxes will vary in size. And sometimes the boxes will have like other pieces of information, like the weekly vector, right, below it, or median range below it. And it won't be an area where there's like all this empty space. There'll be another key level. So one of the things that you can do is like, if there's nothing below, I would just set my stop outside, just comfortably outside to account for market volatility. Now, if there's a key level below, I try to take that into account. I ask myself, based off of what's here, can I see an overshoot into the key level below and then the market reverse? If so, I'm going to set my entry a little bit lower, like at the bottom, and then set my stop below. Now, some of you might say, what in the world, a 40-point stop? Yeah, well, a 40-point stop is very comfortable when you have small size. And this is a problem with many people. They oversize trying to swing for the fences and they get burned so many times. So you can do that. You could set your entry just lower and account for market volatility to maybe overshoot, and then use this weekly vector as invalidation by setting your stop below it. So that's another way of doing it. And then this is just speaking about entries. And then like one other thing you could do is just scale in. You could scale one there, another one here, and 3 here. Your cost basis will be somewhere in here, and set your stop below. So that'd be 5 micros, and very comfortable amount of room in order to give the market some volatility room, buffer, whatever, and just take your position long. So those are some 3 ideas. Consider, ask yourself, okay, if this is a key area I want to go long from, if there's nothing below, I'll just set my stop outside. But if there is a key level below, then I'm going to use that as like a little buffer, and I'll set my stop below. And then if you want to scale in, you could do 1 here, 1 there, 3 there, 5 micro position. Give yourself a little buffer, stop below, and take the long. So basically that same logic can apply for shorts. But again, if your main idea for the day is to go long and market's doing this, you got to ask yourself, okay, number one, if market's continuing to extend like in an outlier fashion, do I still want to wait for this position? That's up to the individual. If so, then you account for waiting and using real-time fractal software. If you don't have access to the fractal software to do real-time confirmation, then you could very well just wait. Wait if the market comes down and how it reacts. Or you could wait for it to do this and then take the entry because you don't have the fractal software to confirm this ahead of time for still high probability setup. Or you could just not take it all together. So this is part of risk management. I can't always tell you yes or no, take it or not take it, because if at the end of the day, your own psychology is getting messed up because you're affected greatly by overtrading or FOMO or not having proper analysis and insight, and you don't have other confirmation tools like the vector, like the fractal software, or using the HMAs like I put on my charts, then you're going to have a very hard time. And if you don't know how to wait, you're going to have a very hard time. So there's a lot of personal psychology elements that play a crucial role in capitalizing on these kinds of setups. So there's the psychological element, and then there's the mechanical element of like execution, the different routes that you can take. So again, you could just set a limit like in the middle, you decide, or you could set a scale in, and then you account for whether or not there's like a key level underneath. If there isn't, you could just set your stop outside. But let's say like your entry, let's say the main idea to go long is like at median range. And then you see this weekly vector, and then you see this box. Again, risk management. How big is your account? How much size are you wanting to take? What is your TP? You know, if your TP is only like 20 points, then perhaps you can size up, or perhaps you just want to take a scalp, even though the big idea is to go maybe 150, 200 points. So there's no one way of doing it. You have to determine for yourself, like, what are you willing to risk? What are you willing to risk? And so if the setup is here at median range, and the weekly vector's right here, you're like, okay, let me just give myself a 30-point stop, because I'm going to let the weekly vector do its thing for any market volatility, and I'll set my stop down here. Now, for example, you could very well, let's say 24,064, right, is the big idea. You want to go long for median range. You could literally, and I've done this before and it works just fine, set one micro, 150-point stop. What is that? Down here, and then just add in more here. The cost basis moves down a ton, and you could just go long. You know, some people are doing that and finding great success. I really want to encourage you, don't give in to what retail says about negative risk to reward and like wide stops. And retail mostly loses money. And if you listen to retail strategies or retail psychology saying negative risk to reward is bad or whatever, or like wide stops is bad, listen, I don't want to listen to people who are losers at trading. I want to listen to people who are winners at trading. And this is very clear risk management. I would be risking a total, if I had a 120-point stop, the risk one micro, $240. That's nothing on a 50K account when you're talking about prop firms. And so typically for the long setups and big ideas for the day, my targets are at least 200, 300 points at least. So you're risking $120 on one micro, targeting 200, 300 points, which we hit very, very often. Then this is a 3-to-1, 4-to-1, 2-to-1 at least, very, very like minimal. So that's the thing. Like, you can really take advantage of how powerful these levels are to take bigger TPs and therefore afford yourself enough drawdown to account for market volatility, as long as you have the proper size in place. So when it comes to setting your entries, you can use the neighboring key levels as like additional buffers for your stop. And then for your take profits, I'm always encouraging people to take money as the market's giving it to you. And median ranges are very powerful levels for that. So if like I'm going long and my entry's like down here, I'm definitely targeting the upper median range at the very least. But also these two levels are your friends, this high of day level and this median range level for going long. Also the wave one daily open stays levels. They're very, very good for going long. But if I would say in order of significance, typically the high of day level is lower than the median range and then open states on the daily time frame. That's for going long. Similar for going short, I would say since the high of day level is pretty much always above or within the dead zone, I would say the opposite side median range, and then any key levels that are trying to provide support. Typically, it'll work like this. There's a median range, there's some supportive area like this, and then there's the floor and wave one daily open states. So instead of using stuff like this high of day at level, just try to look for a supportive area or the floor. So along with wave one daily open states. So that's what you could do for the short side when you're looking for targets. So yeah, that's what I would find very helpful to share with you when visualizing possible areas for entries, exits, stops when you're looking at the chart. And at the end of the day, I can't force you to control your size. I can't force you to not overtrade, to not revenge trade, but you have to do that yourself. You have to spend time with the charts. You have to spend time gathering biases. You have to spend time learning the analysis, the language. You have to spend time with the tools. We have 30-day free trials for all pro members. You have to invest in your growth. And so there's a lot of homework to do. And at the end of the day, back testing can only do so much for you, because you can back test the last 3 months, but the last 3 months could very well be a totally different market environment and condition. So it may not do as well for you as you may be telling yourself. So again, there's got to be an element of forward testing. And one of the ways you could safely forward test is, of course, not only paper trade, but just do small size. And learn how to hold through drawdown on small size. So that's it. Hope this is helpful and that you're able to get a few pointers in order to help you get some better executions on your trades.